So I think the major class people are focused on is direct investments. Most families already have a basic investment portfolio. They have ETFs, they have a bond portfolio, they have real estate. And so looking at direct investments, whether they're doing it themselves or in a co-invest entity, is, I think, the number one area that's a big focus for families. Next would be long-term investing. Families face significant reinvestment risk. Unlike a PE firm where they invest the money, they sell the company, they return the capital to the LPs, and the clock stops. For a family, when the money comes back, when we sell an investment and the cash comes in, I have to turn around and redeploy it. And so what that pushes you towards is trying to find investments that you can own for a long period of time. So Sam has owned investments for 10, 15, 20 years. He's owned one for 34 years. And that's a real big plus when you're talking about families and their capital. I think a newer area is structured opportunities or structured investments, especially post-COVID. It's getting a lot harder to value equity right now and what's going to happen in the next year or two. And so the idea of maybe placing your capital in a convert or a preferred type of instrument is a lot more interesting to families in the last 6, 12 months. And then finally, and I think this depends on the family situation, is how active the family wants to be. So EGI, Sam made his money in investments. And so we're very active. And we're usually leading the investment, and most of our capital is going into direct investments. Other families want to take a minority stake, and they actually partner with us where we'll lead the deal, but they put the capital in behind us. And so I think depending on the family, you'll get a very different view of which role they want to play, which seat they want to sit in. Yeah, I mean, there've been a couple changes. First of all, pre-COVID, everything was expensive. I mean, across the board, public equities, private markets. There was a lot of capital in PE. There was a lot of dry powder, a significant amount of competition for assets and very high prices. And families were trying for the last couple of years to figure out how to even justify paying such high multiples. We at EGI, we've been sellers for the last 3 years or so. One nice thing about family and family capital is there's really not a lot of pressure to deploy capital at any period of time. So if you think prices are high, you sell. If you think prices are low, you buy. And that flexibility is something we use an awful lot. So that's pre-COVID. Now I would say the situation with most families, at least the ones I'm talking to, most families aren't over-levered, okay? Their trusts or wherever the capital is layered typically doesn't have a lot of leverage. Most of the assets they buy, they don't lever them up too much. And people I'm talking to have not run into too many troubled situations so far. And that outlook, or that's given people a good outlook in terms of their willingness to take risk right now. And I would say even more so than the last downturn. I see more families comfortable with trying to deploy capital now versus right after the last downturn. But part of the reason is you got to remember what we're talking about is only a percentage of the family's portfolio. All right. So most families have money, as I said before, in bonds and real estate and things like that are pretty locked down. And so they're able to take more risk with a smaller percentage of their portfolio, which is what I'm starting to see people do right now. I think also, as I touched on before, there's more opportunities for structured instruments. So again, a lot of converts, a lot of preferred, people putting money higher in the capital structure. It's safer. It's easier to put some value around it or valuation around it. And sellers are more open to it than they were, I think, pre-COVID. And look, the last thing, I think people are starting to relook at their portfolio in terms of the industries they're in. They're rethinking their exposure to energy, maybe fossil fuels. There's some ESG issues. People are rethinking retail. So not necessarily COVID itself, but I think the impact of COVID, the after effects of COVID, are getting people to relook at the industry mix that their assets are deployed in. Well, the biggest reason is control. I think what a lot of people forget when you're talking about families, family offices, it's your money. And you're putting it to work and you want to control it, or you at least want to influence it. If you think about it, you take your money, you hire a management team to run a family office, they turn around and hire a firm, a PE firm, whoever, to invest the capital, who then turns around and puts the money into a company who's expected to make you money. So there's multiple steps along the way. And I think the more people feel like they have some control or influence over their investments, the better they feel. So I think that's number one. Two is choice, right? The idea of choosing to buy a particular asset, a particular company, versus putting your money in a blind pool, where there might be style drift. Sometimes the portfolio mix or the exposure over time is not what you originally signed up for or thought you were getting. So the idea that if you invest directly, you get to look at each asset each time and decide, do you want to put your money into that asset? You get to review the management team and the situation. So I think choice is a really big driver. Obviously margin, money, there's a carry, there's fee, and that weighs into the consideration as well. And then I think, look, also the PE industry has matured. There's a lot of firms, there's a lot of talent out there. And I think it's a lot easier today to insource this capability if you're a family than it used to be. You can actually hire staff to build a direct investment team. And I think there's just more people out there who are that competent that families can pull in. And it's not just families doing this. I mean, endowments are focusing more on direct investments, insurance companies, pension funds, they're all doing the same thing. So I think this sort of the maturity of the PE industry in a way has allowed the sources of capital to actually insource some of that capability. Well, look, the two words we use a ton are alignment and transparency. You want people who are aligned with you. So I touched before on the duration, right? If a PE firm wants to invest for 4 years and we want to invest for 15, you're not aligned. If people want to take a lot of risk and you want to take less risk, you're not aligned. So alignment's a huge, huge focus of ours. And the other one's transparency. You may not be controlling the investment, maybe you're a minority partner, but you want transparency. You want to sit on the board. You want to see what's going on. These are both code words for trust, okay? And that's really what we're talking about. And I'll keep going back to, it's our money and it's the family's money, and they want to feel good that they're giving it to people that they trust. So I think the second big thing, and it's related, is families partner with other families. All right, they're people who think the same way they do. They have the same incentives. They have the same issues. We have a lot of families who co-invest alongside of us. Sam, his original business was investing, so we've had this capability for decades. I think some other families, people may have made their money in tech. They may have made their money in manufacturing or logistics. And then they sell their company and all of a sudden they get a lot of money and they build a family office. And they sort of evolve into an investment strategy. Again, they may buy a portfolio, they may give it to a third party to invest. And over time, they evolve to where they start doing more direct investments. And that trust word keeps coming up over and over and over again. And so we found that families actually like partnering with us because we just have a lot of alignment. I think another way to think about it is where we also invest with other families is outside the US. So in South America, there's a lot of family offices. They know their market locally. They know their governments. They know their political situations. They have a better handle on their currencies. And we feel a lot more comfortable investing alongside of them in an investment in their company or country, excuse me, and vice versa. They want to invest in the US and not just sort of go in at a distance, but they want somebody that they can partner with. So families investing together is something that's been going on for years, but I think has actually been increasing. And the last thing I think is, someone said to me a while back, like, it's very hard to crack this family office. It's a tight little circle. Like, I'd like to invest with them. How do you do it? And it takes a while. It takes a while for the reasons I just said. You need to get to know each other. You need to make sure we're aligned, and you need to build that trust. And so it just doesn't happen overnight. Families don't need to do direct investments. They don't need to invest. They don't need to, put money to work every year. And that's a huge difference with some other investment firms. And so they can go slow. And sometimes the time horizon, I think, for other investment firms, feels lethargic because the family does not feel like they have to put X dollars to work, in 2020. They'll wait till next year or the year after. And so that's, again, another consideration, I think, that if you're trying to partner with a family, you got to be very cognizant of. Yeah, it's a tough one. Look, there's more of a backbone and almost an industry growing up around family offices right now. I think it's easier to set one up than in the past. So I don't know what the right size needs to be or anything else like that. But as I said before, there's a lot more investment professionals. I think a lot of the big banks have realized the growth in family offices, and most of the larger banks have parts of their organization dedicated to family offices that provide a lot of back office services. So it's a lot easier to actually get a family office set up than, say, 10, 15 years ago. I don't know if it differs by market so much. I think one of the harder things to work through in terms of thinking through what family offices need to do is it is a family, right? And it's a group of people, and they're typically a family, and some people want to be very involved and some people don't. They may not all agree on what they need to do. Some families have much more of a social bent. Other families just want to protect the money. Some are risk averse. Some are risk takers. Some want to keep investing in the industry where they made money, and others want to do the exact opposite. So I think one of the difficulties when you're trying to service the family market is viewing it as just a market, right? It's segments of markets. There's there's this big spectrum of needs and desires of the different owners in terms of how they want to invest the money and the services they're seeking. So I think that's probably a big consideration as you're trying to either partner with or provide services to family offices.